Major action is being taken by the government in a bid to cool the property market. While still meeting strong housing demand, supply is being ramped up even as a slew of cooling measures takes effect. The supply of private and public housing flats is set to rise by at least 35% next year. The government says it will launch up to 23,000 built-to-order flats per year over the next 2 years. Land sites will also be released that will, in the first half of next year, yield about 6,500 private residential units. But market watchers say measures to cool demand could see developers shy away from bidding on future land parcels. Natasha Razak reports.
Despite COVID-19's impact on the economy, demand for public housing flats has been strong over the last 2 years. Application rates for new flats have jumped from 3.7 applicants per flat in 2019 to 5.5 this year. Resale flat prices have also risen sharply by about 15% since the first quarter of last year. To ensure that the market remains sustainable and affordable, especially for first-time buyers, the Housing Board is now ramping up the supply of BTO flats. These flats will be in both mature estates like Queenstown and Kallang Whampoa, as well as non-mature ones like Tengah and Jurong West. But it's prepared to launch as many as 100,000 units in total from this year to 2025 if needed. At least one market watcher has welcomed the move.
The BTO market competition is very strong. The chances of getting a BTO flat may be very small, so you push some of them into resale market. Now we have more BTO coming up. They probably will shift some of the demand from the resale market to the BTO market. So that will help to alleviate some of the pressure in the resale market.
Supply will also be increased in the private housing market, which has seen prices rise about 9%. Authorities will release around 2,800 units on the confirmed list as part of the government land sales program in the first half of next year. This is a 40% jump from the previous exercise. The announcement is the second part of the government's two-pronged approach to cool the property market. On the demand side, which was announced earlier, changes include a rise in the additional buyer's stamp duty. Developers purchasing residential property will now have to pay a rate of 35%, up from 25% previously. Analysts say this could make developers more cautious when bidding for future land parcels, especially with the challenges facing the construction sector right now.
For example, some of the bigger developers that has more finances, so they may continue or proceed with buying some of these land parcels, but perhaps at a lower price. But for smaller developers or even foreign developers, some of them may take a step back or even perhaps bid for fewer land parcels.
Ms. Sun adds that demand for larger land parcels, which can yield over 1,000 units, may also fall. With a possible market slowdown from the cooling measures, developers may not be able to sell all their units within 5 years in order to get their ABSD refund.
Well, Singapore says the move to immediately implement the new cooling measures is to reduce the risk of a self-reinforcing cycle of price hikes in its private and public housing markets. National Development Minister Desmond Lee says the measures will help keep the market sustainable and prices affordable. Natasha Razak with this report.
With housing prices reaching new heights, a slew of measures kicked in today to cool the market. These include raising the additional buyer's stamp duty for Singaporeans buying their second and third properties. They'll now have to pay a rate of 17% and 25%. That's 5 and 10% higher.
Demand-side measures, where Singapore citizens buying their first property remain exempt from ABSD, while rates for property investors have been increased, will also help moderate demand in favour of home buyers.
Foreigners will have to pay an ABSD rate of 30% for any property they buy, up from 20% previously. Steps are also being taken to prevent buyers from taking on too much debt from their property loans. For one, the total debt servicing ratio will be tightened from 60% to 55%. Those getting a loan from the Housing Board will see their loan-to-value limits cut from 90% to 85%. And while the house price to income ratio has been increasing in both markets, Mr. Lee says it's still below their historical averages. demand for housing in Singapore has remained strong despite the uncertainty caused by the pandemic. This has led to a clear upward market momentum as more and more transactions are made and prices keep rising. Left unchecked, Mr. Lee warns that prices are likely to run ahead of economic fundamentals.
This will increase the risk of a destabilizing correction later on that will hurt many households. Borrowers will also be vulnerable to the likely rise in interest rates in the next year and beyond, as major central banks look to tighten monetary policy to respond to inflation as well as the recovery in their economies. A combination of rising prices and higher interest rates will risk a significant increase in debt servicing costs for future buyers.
Mr. Lee also explains that the new measures seek to prioritise demand for genuine owner-occupation purchases, especially first-time home buyers who may be concerned about the strong competition for public housing. That's why the supply in both private and public housing markets are also being ramped up. Mr. Lee notes that housing demand has increased not just as a result of low interest rates. Household sizes have become smaller, and larger cohorts of those born in the late 1980s and 1990s are also reaching marriageable age. Mr. Lee urges homebuyers to be prudent when purchasing their flats so that they can continue servicing their mortgages sustainably over the long term.
Property agents say buyers and sellers will likely adopt a wait-and-see approach over the next month to see who will gain the upper hand from the new cooling measures. But as Heidi Ng reports, some analysts are expecting prices of both public and private housing to continue rising in 2022.
Surprise and then concern. Many home buyers and sellers were caught off guard when they woke up to the news this morning. Property agents say their phones are buzzing all day from anxious clients, especially those looking to sell.
Maybe in the next 1 or 2 quarters, perhaps if the prices may start to stabilize and perhaps some sellers will be a little bit more realistic and willing to accept prices which is based on last transacted rather than looking at what has been transacted and add a premium to it.
He likens it to a tug of war over the next few weeks, waiting to see if sellers are willing to accept lower offers and if buyers are still willing to pay a premium. Analysts also expect property prices in the outside central region, such as Sengkang and Punggol, to remain resilient, as many of the homes there are owner-occupied. But in the core central region, smaller units in upscale condominiums that appeal to investors will likely see more correction. And although the new measures are mainly targeted at investors, analysts say that given the reduced total debt servicing ratio, home buyers may also need to redo their sums.
This will not just affect real estate loan. It basically affects all loans, including car loans, credit card loans, unsecured loans. So first-time home buyers will also be subjected to the total debt servicing ratio. So in other words, everybody is affected.
Analysts expect property transactions to drop by over 30% in the next 2 months due to the festive period and the wait-and-see effect. Still, they expect strong demand from certain clients, like upgraders who have already sold their current houses.
Some of them might be actually thinking that I would want to hold for as long and let this whole prices keep going up. But perhaps, right, if they do not see much upside going forward, they may actually want to be more motivated to sell and to cash out at this moment, while the market is still very healthy.
While real estate agencies have made downgrades to their price forecasts for 2022, they are expecting a rise of around 5% for HDB flats and about 3% for private property. With inflation steadily rising this year, agents also say that higher interest rates would be an additional blow to home buyers.
Our property developers are asking the government for some leeway in managing the new cooling measures. They're describing the curbs as tough and unexpected, coming just as the market is starting to emerge from COVID-19. The association representing Singapore's developers says they will have to shorten the timeline for their property cycle so that they can meet the stringent requirements needed to get a refund of their 35% additional buyer's stamp duty. It's also asking for the remission criteria to be differentiated for projects of different sizes, given that the construction sector is still hard-pressed pressed to meet completion deadlines. Real estate counters in Singapore's stock market took an immediate hit this morning, but recovered slightly at the close. Real estate services like APEC Realty saw shares slide by over 10%, with Propnex falling nearly 4%. Developers saw more muted declines, CDL down just under 3%. Analysts say the drop reflected a normalization of the market. They point out that property services counters have been rising since the start of the year, driven by a boom in the market.
If we look at property developers, their share price has already been trailing behind the broader market. So they didn't enjoy that, run up in the share prices as compared to other sectors. It suggests a downside impact may potentially be limited because their valuation at current point of time, even before the announcement, still seems relatively attractive.